Hey everyone! Today I'm diving into some financial secrets that every finance student needs to know. By the end of this video, you'll have a solid grip on present value and risk management. Let's get started. First up, present value. Imagine you could travel through time with money. Present value is like your financial time machine. It's the amount of money you need today at current interest rates to reach a specific future sum. This concept is crucial for evaluating investments and understanding the worth of future cash flows. Think of it as comparing apples to apples, no matter the time difference. Now let's talk about managing risk. Life is full of uncertainties, right? Risk management is all about understanding and reducing those uncertainties. It's essential for making informed financial choices. Most people are risk-averse, meaning they prefer avoiding uncertainty. This stems from the principle of diminishing marginal utility, where the satisfaction gained from additional wealth decreases as you get richer. People would rather avoid losses than chase equivalent gains. Enter the markets for insurance. Insurance is a powerful tool for transferring risk. By paying a premium, you shift the risk to insurance companies, which then spread it among many policyholders. But there are challenges like adverse selection, where high-risk individuals are more likely to buy insurance, and moral hazard, where insured individuals might take on more risks. Next up, diversification. Ever heard the saying, "Don't put all your eggs in one basket"? That's diversification in a nutshell. By spreading investments across different assets, you reduce risk. A diversified portfolio can mitigate firm-specific risk, but remember, it can't eliminate market risk entirely. Now let's discuss the trade-off between risk and return. Higher returns usually come with higher risk. As an investor, you need to decide how much risk you're willing to take for potentially higher returns. When it comes to asset valuation, understanding the present value of expected future cash flows is key. For stocks, this includes dividends and the final sale price. Fundamental analysis helps investors evaluate a company's financial health and future prospects to find undervalued stocks. The efficient markets hypothesis suggests that asset prices reflect all publicly available information, making it tough to consistently beat the market. But market irrationality shows us that investor psychology and speculative bubbles can cause significant price fluctuations. In conclusion, mastering present value, risk management, and asset valuation are essential for making smart financial decisions. While the efficient markets hypothesis gives us a framework, never underestimate the role of irrational factors in asset pricing. Thanks for watching. If you found this helpful, don't forget to like and subscribe for more financial insights. See you next time.